All right, so what we're looking at here is going to be the loan estimate. This is probably the most important form to look at when you're actually buying a home. Reason being, it breaks down the estimated closing costs, payment, etc. So, first section I always look at is the top right corner. You want to make sure that if you're expecting a fixed rate, that it says fixed rate. Depending on whatever loan product has been discussed with your lender, you want to make sure that fits in the box here. And last but not least, if the loan and interest rate is actually locked. As you can see here, there is one interest rate option, but if you want to compare lenders and actually compare apples to apples, you have to make sure that your lenders lock in the interest rate. Anyone can put what they want on this form prior to locking the rate, which is incredibly unfortunate, but that's why you want to make sure to look for that to make sure it's actually accurate. Now, there's always one rate chosen here. However, you're going to have probably 10 to 20 different interest rate options available to you. Just depends on your goals for the home. So if your lender does not give you multiple options, I highly recommend speaking with someone else, as they will be able to go ahead and make sure that you get the right option for you in your financial situation. Now, cash to close and closing costs are what I'm going to go through here, which basically first is section A, which I mentioned a moment ago, how you have the one option for the interest rate on the loan estimate. The points are what are associated with that one option. So if you pick a higher rate option, then your closing costs will be lower, meaning your points would be lower, or actually maybe even eliminated. Now, if you go lower in interest rate, though, then the points will increase because basically you're paying more in upfront interest for that lower payment, lower interest rate. One thing to note, points are tax deductible, so definitely something to chat with an accountant about and see if it makes sense for your scenario. Now, processing and underwriting are very standard fees on every single loan. Then next is going to be Section B. Section B really is going to be appraisal, credit, and flood cert with all these extra miscellaneous fees added, but generally at the end, they get completely removed from your closing costs. So the appraisal is a neutral third party going out to the home to determine the value. Credit report, pretty standard there. And flood cert is just making sure that your home is not in a flood area. Now next is going to be the title company fees, which are in Section C. The title company is once again another neutral third party that handles any money that you send for the transaction, any money that goes to the seller, us as the lender sending them money. They record the home with the county. They kind of handle a lot of the paperwork from the legal standpoint of making you owners of the home. Now next is going to be Section E, which are generally two things: recording fees with the county, and if there are any transfer taxes, paying those there. Typically they are seller paid. However, every state is different, so make sure to talk to your realtor or your lender, and they'll be able to tell you if you'll pay transfer taxes or not. Now, Section F is going to be the prepaids, which basically is prepaying a full year of homeowners insurance. So whatever number we get from the insurance company that you pick is what will be paid right here. Now, next is going to be prepaid interest, and this might be the most confusing line on this page, but basically, let's say in this instance, they're closing with 5 days left in the month, and we're going to assume that this is the month of June. So if they close with 5 days left in the month of June, the first mortgage payment will be on August 1st. That August 1st payment covers all the days that you live in the home in July, but none of the days in June. Therefore, we have to collect interest from the day you close through the end of that month. Now, homeowners association dues, if there is an HOA, they typically collect 1 month here. However, normally this does actually get removed. Now, next is going to be Section G, which is basically, we can think of this like a piggy bank for your taxes and insurance. So for instance, you're paying a full year in Section F, but you're seeing a 3-month buffer here in Section G. And that's exactly what that is. In case there's any change to your premium next year for insurance, we really want to make sure that you're not coming out of pocket for that money. Therefore, a 3-month buffer is collected for insurance. Now, next are the property taxes. Same idea. Taxes are due either once or twice per year. So we want to make sure you're not coming out of pocket for the taxes, which is why we're gathering a full 6 months here in this section. That number does change depending on when you're closing in the year. Can be lower, can be higher, but 6 months is actually kind of typically around the high point as to what's collected. The next is going to be Section H, which is another section of the title company fees, which you'll see here an optional fee of about $1,000. That basically protects you if there are any liens on the property that the title company is unaware of. If you choose not to get it, since it is optional, then the Section C fees go up by almost that exact same amount. So really, it just ends up being a wash. Now, next, you'll see the breakdown of the total estimated closing costs, the down payment that the client is bringing to the table, the initial deposit that the client already made, which basically goes towards their down payment. And then lastly, there was a seller credit on this transaction. Therefore, we're factoring that in as well. So when people mention cash to close, that means the down payment plus closing costs after factoring in things like deposits, seller credits, etc. So if you ever have any questions, please reach out to us. We'd obviously be happy to help.